the book is about how to analyze quality. But I do think that higher quality and higher durability, all else equal, means that the company has a higher value and lower risk. Mm-hmm. So, and investing is really about buying assets that you think are worth more than you pay for them. Yeah. So if you have like a high conviction in what is the quality, and actually I would go make it even more precise to say, what is the various future level of quality across various scenarios of the future that you have in your mind, then you are in a better position to determine the value which you need. Otherwise, you cannot be an investor.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Simon Kold. He's the founder of Kold Investments, a Copenhagen-based investment firm. He was previously at Novo Holdings, one of the largest investment organizations in the world. His investment experience spans both public and private markets. Simon is one of the few fund managers who also has a degree in theology and had a stint in stand-up comedy. His book, On the Hunt for Great Companies, An Investor's Guide to Evaluating Business Quality and Durability, was published by Wiley in late October. Simon, how are you? So nice to see you again.
I'm good. Thank you, Bogumil.
So I'll take a little risk here, and I'm going to say that you might be the only fund manager who has a degree in theology and experience as a stand-up comic. What do you say to that?
Maybe, I don't know, maybe some people will come forth. There was actually another guy at Novo Holdings who did stand-up comedy in the San Francisco comedy scene. But I don't, I'm pretty sure he didn't study theology also.
Maybe there's something about Danish investors that you need to have a stint as a comic to actually get good at it. I don't know. There must be some secret.
I don't know. I know a lot of Danish investors. I also know a lot of Danish comics. And as far as I know, there's not so much overlap.
It makes me think that comic are good investors, or investors have to be comics to get through some parts of moments in the markets as well. Last time we spoke, I found you in your family summer home. It was summer beaming through the window. Today I'm catching you in a loft, a different part of the year. I think it's cooler outside too.
Yeah, totally. It's cold and it's dark, and yeah, it's winter here now.
It's amazing how quickly it changes. I want to ask you 1,000 questions about the book, On the Hunt for Great Companies, but you might know by now that I like to start those conversations with the early days, and I ask my guests about their childhood upbringing and how do you think that time shaped you, your relationship with money, and the career path that you chose after being a comic for a bit.
Yeah, sure. So I grew up in a city called Esbjerg. It's an industrial city in Esbjerg. Actually, it's known for smelling of fish. But then the people there, they say, you talk about money. The people there, they're not very cultural. They're not very sort of cultural, but they're very mercantile. And they say it doesn't smell of fish, it smells of money. but no, it was a good place to grow up. I had a wonderful childhood. I had some very good teachers. I didn't have a relationship with money really or investing in any way. I always kind of just wanted to do something that was different, I guess. I was really into a Danish TV show called Kasper Mandrill-aftalen, sort of an absurdish kind of comedy, very weird, like probably in an American context, the most similar would be like maybe something like Tim and Eric or Monty Python or something like. And I started, after high school, I started doing stand-up comedy. So I was working and I took the train 2 times per week to Copenhagen to go to open mics for free. And then I moved to Copenhagen a year after. And I had a little bit of success in the comedy scene. I got a little bit more status, and I eventually got to do some TV programs. And I kind of got semi-famous among sort of a cohort of weed-smoking high school students or something like that. So I went on this national tour with some of the other comics, and I was actually pitching for my own TV show, like my Simon Kold's TV show on national television. And then I studied theology at the University of Copenhagen, and it was probably not a super thought through study, choose of study, but I was interested in theology and philosophy, and I didn't think so much about the career path. And I think after having completed that, and after having realized that to be a professional comic in Denmark, you really have to do like corporate gigs, like you have to go to companies. And my stand-up style was very niche. It's not the kind of typical, when you hear stand-up comic, you think about the guy moving fast around and saying. It was very like one-liner, deadpan. So if you know like Stephen Wright, Mitch Hedberg, Dimitri Martin, some of those kind of American and comics would be example of that. So very hard to break out of your stage persona, but worked very well in a comedy club. But I think anyway, I realized that was a mistake. So then I went to business school. I did 2 years at the business school. I thought, I'm already an academic, I just need. I seriously had doubts that I would ever be able to provide for a family, because I was like, why do you always have to be like so opposite? Like, why can't you just be like 10% more normal? Like, why do you have to make these always idealistic decisions? And then I for some reason, I was allowed to begin my master's degree in finance without having completed the undergrad in business school. But anyway, it worked out. So I have a master's degree in finance from Copenhagen Business School, and then a bachelor's degree in theology. And that's my education. And then while I was doing my master's thesis, I got a job at Novo Holdings, which I ended up being there for 10 years. And it was an awesome, and still is today, an awesome place, awesome management, really great people there, great institution. And it was through that job, I think, that I got hooked on investing. So I had started reading some investment books and just kind of got hooked on this sort of path of self-study. So because it's actually kind of interesting, because I had been so much away while I studied theology, I wasn't really attending a lot of classes because I was on tour and stuff. I had learned by sort of by accident, you can say, to be really good at self-studying. It just kind of happened because I had to do it. I had to learn myself Latin without attending classes. I had to learn myself classic philosophy, and just reading the not with a textbook, but like reading the real scripts and pass exam. And that was a good way to learn to be good at self-study. So I kind of that has, I think, followed me, and also into my career as someone who just reads a lot of books, and kind of, so I got hooked that way. And probably everybody, like I also mentioned that I was on Investing by the Books, and I also mentioned that there are probably someone who listens to a podcast like that, and probably also like they're probably the same kind of person. Like if you are, there's a lot of people in the investment industry who just, they take on the suit, they go to the work, they do the job, the slides or whatever, Excel models, they do it, then they go home. And then I think you have some people who just they're driven by something entirely different, right? They're driven by they got kind of hooked on this pursuit of knowledge and stuff. And anyway, I was probably in that camp, right? And I just got hooked on it. And so I never had actually any relationship with money, really. In fact, I would go as far as saying, if you had jumped back in time to 20 years Simon Kold and asked him, hey, do you think it could be cool if you are running a fund when you are like in your late 30s? I would have probably said like, hell no, that would be not cool at all.
Do you have a memory of shortage of money at home growing up?
I definitely have a memory of having a lot of shortage of money when after moving away from home. I was always broke. But I think we were never like poor. Like we were just sort of regular middle class. So no, not really shortage. We were never poor of shortage of money in my family. But it was always like, my parents are very frugal. They are like, especially my father, but also my mother, they can like haggle over the price of bananas in the supermarket. And my father, he's always like, when he has this, like when he has earned 100 kroner, he puts 50 to his pocket and he never takes it out. So, but we never missed money, but just very kind of frugal. And I think I'm also quite, it's sort of printed in my mind, this.
It stays with you, doesn't it? If you see it. I want to bring up the fact
when you... What about you?
Oh, yeah, you want to turn it around? Well, I grew up in Poland, and I got to see the last 10 years of communist Poland. So I didn't realize at the time, but statistically speaking, I wasn't growing up with a lot, but I had no understanding of, how broken the economic system was in the country. And then only later I realized there's a whole world outside that works so much better. And Denmark was one of the places I visited as a young teen and got to see a whole different world that functioned. The stores were full and there was a supply of things. There were no shortages of things. And I realized you can organize the world better. And maybe that inspired my fascination with economics and politics and how does the world work and why does it work in one place and it fails to work somewhere else. So that definitely inspired me. I want to bring up theology for a second because it makes me think of a couple of individuals in the investment profession. One of them is Nick Sleep, who I'm sure you're familiar with.
Yeah, sure.
A legendary investor. And he talks about investing as a spiritual pursuit. It's not just turning money into more money. And I think there's something to it. You can see it as instead of laying bricks, building a cathedral. And speaking of a cathedral, I remember Chris Davis, who is also a famous investor. He had an interview with William Green and talked about his experience. I don't know if he got a degree in theology or wanted to get a degree. I might have to go back and look it up. But Lauren Templeton, who was on the show, mentioned to me how Tom Gaynor told Chris Davis how the stewardship of other people's capital is that higher calling because you're responsible for people's livelihoods. Almost like, I don't want to exaggerate, but, a priest or a doctor, you have a certain calling. And it's fascinating how many of us find this pursuit so interesting. And to me, it goes beyond turning this amount of money to a larger amount of money. You have to have huge respect for the money that you take care of. And I think there's something, for lack of a better word, spiritual about it. I want to jump right in and ask you about the durable companies that you're looking for. Why does investing in high quality, durable companies make sense?
Yeah, well, I don't actually think necessarily that investing in super high quality companies leads to a better investment outcome than investing in other kind of companies. That's, there's this term called quality investing, which typically most people refer to it as fundamental belief that investing in high quality companies is better. But I don't necessarily believe that myself. I think the book is about how to analyze quality, but I do think that higher quality and higher durability, all else equal, means that the company has a higher value and lower risk. So, and investing is really about buying assets that you think are worth more than you pay for them. Yeah. So if you have like a high conviction in what is the quality, and actually I would go make it even more precise to say, what is the various future level of quality across various scenarios of the future that you have in your mind, then you are in a better position to determine the value which you need. Otherwise, you cannot be an investor. And then you are a speculator. I think if you have no so I think that's why I think the distinction between, like, I actually made it very clear at the end of the book also. You cannot just be like, okay, I assessed quality, check, now I check value. Like, that's not really my intention, right? But my intention is just to focus narrowly on determining quality and not determining value.
When you think of those companies, a couple of things come to mind. So first of all, I think of general value investing as a philosophy going back 100 years or so to Ben Graham. I think of it in my own vocabulary, a static way of looking at things. So Graham would buy companies that were worth $1. He would pay 50 cents, and he would look at the balance sheet, and really these companies, a lot of them were worth more dead than alive, so to speak, right? And you only knew that you're going to get $1, and you walk away and move on to something else. Now, at some point, Buffett showed us with Munger's Inspiration, and Phil Fisher probably too, with his Common Stocks and Common Profits, that if you hold those businesses, certain businesses, over a long period of time, you truly benefit from compounding within one business or a collection of them, right? And that's more of a dynamic way of looking at things. When I was reading your book, I was thinking you're trying to help us figure out where these businesses could be. Not where they are, but where they could be, right? And that's where the value creation, you talk about value capture, extraction in the book. We'll come back to it in a second, but that's where the opportunity arises. I don't know if it's, there are many different ways to invest. This particular way appeals to me. I like quality businesses. I think they are less of a headache to hold and easier to establish value. I think there's some companies where you can't really establish value. I don't know how to. But with these companies, there's some sort of predictability to it. We'll come back to the analysis itself, but I want to start with people. At the beginning of your book, you talk about the people who are running these businesses, and you talk a lot about the passion, enthusiasm, motivation. Why do these things matter? And how do you sniff them out, to use one of your words from the book?
Yeah. So let's start with why they matter. So I have this fundamental belief. I don't know if maybe I should first say there's this very interesting academic work that has been done by an economist called Henrik Bessembinder, where he you can maybe link to it in the show notes. So he basically measured the total shareholder value of wealth creation if you are like buy and hold investor. So you bought the entire stock market in 1926 and then you held it until today. And he looked at the statistical distribution of the excess value creation over T-bills. And it turned out that actually only 4% of the stocks in that population, so the entire US stock market over nearly 100 years, accounted for the entire net shareholder value creation. So if you are like a buy and hold, like forever hold investor, the only way to have success is to be exposed to those 4% of the companies. And then, so it's actually quite a kind of power law distributed, kind of like venture investing, where you have like some huge winners and a lot of ones that either don't matter or you lose money on them. So, and I think, and I have no proof of this, but I think that focusing on companies with very, very, very passionate people will increase that optionality. It will increase the likelihood of being exposed to that power law dynamic, because great decisions compound over a long period of time. Right? I can't prove that empirically, but that's my belief. That's kind of my theory. If you have a shorter time horizon, probably doesn't matter at all. So if you're betting on quarterly earnings calls or something, I mean, then it's probably a total waste of time.
Different.
Then how to sniff it out, and that's probably also a good way to then talk about what do I actually mean by passion, because it's such an overused word, right? But I think I have this chart in the book. I can maybe kind of read it out loud. So I have this idea that there are these effects of passion, like product knowledge, product enthusiasm, having this sort of love or feeling of guilt or responsibility towards customers, employees, suppliers, shareholders, thinking really long term and not short term, having perseverance through setback, being driven by internal motivation. But then you can see something that correlates with it, I believe, like high employee retention rate, high retention rate of management below you, a long tenure within the company, a long tenure within the industry, and then you have some negative determinants like very high salary, high bonus, inauthentic communication, short-term optimization, stakeholder controversy, stuff like that. But I think, I don't actually think you need to overcomplicate this. If you study all the entire communication of an individual, it's often pretty easy to based on your sort of, with no investment experience at all, just experience from interacting with other humans, to tell if you have processed sufficient data, whether or not they are actually passionate about what they do. It's hard to put that on a formula, but you know what I mean. I think everybody listening to this knows what I mean.
We can pick up on it. And I think in any pursuit, you can tell that somebody's passionate about it or that it's something they had to do. I had Christian Billinger on the show, who I'm sure you're familiar with. And he and I had a discussion about people that will do the right thing, even if nobody is watching. People that just have to do the right thing. And when you have a business that you own as a shareholder, you own a couple of shares or maybe 1,000 shares, or doesn't matter. You want the people running the business to be folks that you can trust, and they will do the right thing, even if you're not watching. And they have to be doing it for reasons that go beyond money. When you really think about founders that spend the next few decades running the business, it's their baby, it's their calling, it's their mission, it's something they really care about. Financially speaking, we exceeded any incentive system that's needed to get them out of bed. That's not why they show up. And it's fascinating once you notice it, and hopefully they stick around long enough for the business to grow with that. And I want to bring up you brought up tenure, and I'm curious about something you write about in the book: long-term incentives and incentives about focus on short-term profits and short-term benefits. I think what we're witnessing these days is that there's a lot of attention that's paid to very short-term. You brought up, quarterly earnings, short-term results. Even the turnover in the management these days is very high. I go to the same conference, a few years in a row, and sometimes I realize I might be the person that has been with this business as an owner, shareholder, longer than any CEO in the room, which worries me. And can you talk about how you think about those long-term incentives, which I think we don't have enough of?
Yeah,
in the world that's. Yeah.
I think I use this analogy of like, if you think about a marathon runner and you want to give a marathon runner the right incentive package to increase the likelihood that the marathon runner will win. I just think that giving the marathon runner a huge incentive to lead after the first mile, that is going to increase the likelihood that that runner will lead after the first mile, but decrease the likelihood that he or she will win the race. I think it's much better to give a bonus for actually winning the marathon race. And I just think you see a lot of these compensation packages that are sort of, there's so many, but I think there's no perfect, but if you read proxy statements and you look at them, there's sometimes there's just huge incentives to not take any risk at all, to just keep your job. Or there is a huge incentive to boost earnings in a short time period, which can lead to, incentive to take short-term measures that actually destroy long-term value. There could also be a disincentive to increase the share price, boost the share price, pump the stock. There's all these, I think, things that have been put in place by a board of directors trying to create an incentive that just creates problems. I think it's actually much better if you just have someone who gets a pretty low salary, then they have a pretty significant shareholding, so they also take part of the downside and not just only the upside. And then if they have some kind of system, it's preferably something that vests over many years, vest in the form of shares, and that I like, and but it's like there's nothing that's perfect. I don't have the formula for necessarily how it should be, but I just see a lot of stuff I don't like.
Would you say that you see differences between the US and Europe when it comes to compensation?
For sure. I think I even mentioned that. But I think in the US you have sometimes these. In Europe you have a lot of these salaryman packages where it's like a huge base salary, at least for European standards, and not so, you don't have so much tied to shares. So people don't upending that many shares, and then it's seemingly also okay to just sell them when you get them. Whereas in the US, I mean, you're way more aggressive. But I also think just when you look at the US, you see a lot of, just in my mind, like crazy schemes, like outright, like, why do you need so much money? And like, they just seem like so much out of proportion. So I don't think that's right or wrong. And I think actually, if you look at a lot of European CEOs where they maybe not own so many stock, but they own like a reasonable amount of stock, or maybe they actually own less that you would want, but then they're still clearly very passionate about what they do. And that outweighs it, because I think internal motivation totally trumps financial incentives. But I just think when you find these people who are really internally motivated and have been at a company for a long time, I just clearly see a pattern. I haven't made sort of some kind of academic study, but I clearly see a pattern that they also tend to actually own a lot of shares.
They want to be owners along with everybody else. It's it's fascinating. I'm thinking about, we've been talking about, the CEOs, the top management, and you talk about the communication incentives, things that we can look up, the proxies and documents, we can look it up, and we can listen to earnings calls or read transcripts these days. But I'm thinking about people, 5 layers lower or 10 layers lower. And I noticed that you might have a celebrity CEO or a founder, but then are you translating the same kind of, passion, enthusiasm, and even financial incentives all the way down so that people feel like they're a part of the success story? That's a bit harder to evaluate. How do you look at it?
Well, I think you can see the incentives. I always look at I have a table in the book where I show it for TSMC, for example, where I show the entire management team, as all the ones I could get data on their salary and their shareholding and their tenure. How long have they been in that role? How long have they been with the company? And I always try to do that. And I also always made this other table with Apple where I looked at how was the management team composed in, I think it was 2018. And how was it composed in 2023 or 2 or something, just to see like what was the turnover of those people. And I also tried to evaluate communication of the people below. I think, one of the people who reviewed my book was an operator, an owner of a big online classifieds business here in Denmark, and he told me like his criticism was like, what about evaluating the employees? The employees so you focus so much on the management, you should focus on the employees. And he's right, and he's 100% right. But it can be a little bit difficult to do. But I also just think, like if you have the great people on the top of organization, that tends, like in case his company, I would love to invest in his company. Like he has great people back below him. He's a great guy. And they've been there for a long time and so on. But it's not a publicly traded company, so I can say no issues there. But I think you need to look at it. I think you need to look at it because you can have this sort of, as you mentioned, this rock star founder CEO who doesn't want to give away anything.
Yeah, I think it gets tricky. It's important, but I think experiencing the company in many different ways, maybe even as a customer, you can see how average employees feel that they're treated. I think there's an overall, just anecdotally speaking, challenge with the turnover among employees. And I have all kinds of service providers that I experience in my work as an investment manager. And people tell me, oh, I've been here a long time. I ask how long, and they say 3 months. Well, 3 months is not a long time. And I think people have a different perception of what long-term means. And I think it's harder and harder to find employees that have been in places, especially in the US, I don't know if Europe is the same, that have been at the same place for more than 3 years and 5 years. I personally have spent a long time at different places where I worked. And I noticed that I was more of an exception than a rule. But you can't really get to know people and get to know clients and earn people's trust if you don't stick around. So that was my philosophy. As you know, I manage money for families, and longevity matters, continuity matters. I want to ask you about an important point of your book, which is capital allocation. You share in the book how the role of a business manager is two things: optimizing long-term profits. I'm going to emphasize long-term. I really like that. And allocating those profits. It's something we don't really think about as much, but it's very important. Where does this money go? Does it go back to us, shareholders? Does it get reinvested in the business? How is it reinvested in the business? Can you talk about how you think about it from the perspective of quality, durable businesses?
Yeah, sure. I think the best book on this topic is The Outsiders by William Thorndike, which I also reference in the book. I think so. There's a lot of people who rise through the ranks of a company and they are really good at running the business, but they don't really learn to allocate capital. And then when they get to the CEO position or to board positions, they have to allocate the capital, but they haven't really maybe totally sort of not thinking necessarily totally logically about it. But really it's not that complicated, right? You have different ways to allocate capital. You have a range of organic reinvestment options. You have, maybe you can buy other companies, you can sell assets, you can pay down debt, you can pay dividends, you can raise debt, you can do all sorts of stuff that will raise capital or pay back capital or invest it into assets. And really what you should be doing is just like an optimization exercise, like what will generate the highest return per share over an infinite time horizon. So for instance, if you have a company that's like trading at like what you think is way below its intrinsic value, then your hurdle rate for organic reinvestment options should be higher, because your cost of capital should be determined by your alternatives, which would in this case be buying back your own shares. I think it's more, that's very easy to say and so on. But I think when you look at it, I think there's some interesting stuff you can look at from the outside. So for instance, when you evaluate communication of people, you can look for whether they basically understand at an even micro level of capital allocation, the consumption of capital. So for instance, when people talk about unit economics, I generally like that. I generally like just the fact that they talk about unit economics, but especially if I can see that they actually understand that even like an incremental customer is an investment decision. It ties up capital. And you're not just winning a customer for the sake of growth's sake. You're doing it because it's a good return to have that customer. If it didn't justify the cost of capital, you should do it. Like, I like that. I just also like, just in general, when they make some kind of investment in anything that ties up capital, that they express some kind of return expectation or excitement about the returns, and not just, we do it because that's the way it is. That's how we do it. That's how everybody else is doing it, blah, 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 blah. And also, I think when you see, unfortunately, you see a lot of people who kind of, they have maybe read The Outsiders. they try to talk like that, but then I think it's nice to see people like who have done where you have a history of actually doing stuff where you can see they were going against the crowd, like they were going against the peers of their own industry. You know, maybe they were very conservative in the good times, more so than the companies in the industry, and then when it got tough times, they were very aggressive, either on buybacks or buying competitors and so on, instead of the opposite. I think there's this paradox. For some reason, a lot of investors I talk with, they always want buybacks. They always want buybacks. Buybacks. We should always have buybacks. But I think, if you look at it statistically, I think a lot of companies, they actually buy back stuff at the wrong time. And probably there's a bias to be touting buybacks, because since you have invested in a company, you think it's undervalued. So you think they should spend the money on buybacks. But, right. There's a selection bias, because it's your investment. Everybody else thinks whatever they have invested in is undervalued, so they should be doing buybacks. So I'm a little bit I like buybacks, and I like these kind of, especially when, what I really like is when the management is sort of actively taking the share price into consideration when justifying buybacks. I like that. They might still be wrong, but I just like that.
You make an interesting point, because the truth is, anecdotally speaking, that you see that companies, when they're doing very well, when the price is high, when the cash flow is flowing nicely, that's when they go out and they buy shares. Now, when it's a downturn, and especially when the price drops, they pause the buybacks, which would be the time if you want to take advantage of a lower price, do the buybacks then. But other things happen at the time because the business might be at risk. They're saving the cash just to see how much they have to buffer the downside.
You have these wonder stories of people who created enormous value from it. For instance, like Henry Singleton, right. And I also think a great example would be Apple in the latter part of the 2010s when they managed to buy back, I think, close to half of the shares outstanding. Like that was really good for people who, like me, invested in Apple and then held it like that. Like to have share price, to have the share count half was like when you have sort of a business that intrinsically compounds in value, that just doubles your money multiple. I have met many management teams and board members where they are like they don't think about it this way. It's more like, okay, we make some money and then we use it this way, and we don't think about why we use it this way. We just do it this way because that's how you do, And then at the opposite side of the spectrum, you have people where it's very, very obvious that they think about the denominator and the denominator effect of sort of long-term value per share.
I'm sure there will be more studies of the results of buybacks, and I'm sure there will be some success stories. I want to talk about competitive advantage. When we think about durability, you talk about intense and durable, and competitive advantage is a term that's been used in many different ways. In your book, you go really deep, and you try to show to us how do you define and evaluate a competitive advantage. How do you think about it?
Yeah, so I think it's already, as you mentioned, like it's already so well described. There's so many books about it. I don't think I have anything new to add in terms of new types of advantages or anything like that. What I try to do in the book is to say for each of the types of sort of main archetypes of competitive advantage, first of all, what are the subtypes within that category? Second, what are the determinants of intensity and durability of that advantage? So the analogy I use also to explain it is, if you think about the Colossus of Rhodes, this was this magnificent wonder of the world. It was very spectacular. It was very intense, but it only lasted for 54 years. So it was not very durable compared to the pyramids, right? So you can have something. So I think the parallel that would be something like MySpace, right? It had very, very intense network effects, but they didn't prove very durable. Then you might have another business where it has very, very durable effect, but it's much more subtle. It's not that intense. And anyway, so for these types, I try to list what are the determinants. So this is kind of the synthesis of stuff from other books, from academia, all kind of stuff that I have just tried to make more tangible in terms of day-to-day business analysis, I think, than at least any book I know of myself. And maybe there are books like that out there. I don't know of them. I've just tried to make it like more practical than what is in the literature today that I know of. Like make it very easy to implement it, like almost like an analytical recipe. Like what are the hypotheses you want to test? And what kind of data do you need to get to test it? And some of it, depending on whether it's sort of can range in difficulty, of course. It's very difficult if it's like local network effects across like many, many different geographies. Then it requires, of course, a ton of work compared to. So it's like different. But I try to provide this recipe for it. And yeah, but I think it's also great. It's also great to I mentioned this on other podcast. Maybe people get tired of hearing it if they listen. But I also have this idea of competitive disadvantages. Mm-hmm. So, like, you see a lot of investors, if you listen to these, especially these kind of single company podcasts or stock pitch kind of podcasts, I call them. You always hear about these competitive advantages. This company has this competitive advantage, this competitive advantage. There's something that doesn't make sense statistically, right? If all of these companies have competitive disadvantages, there must be like so many companies with competitive disadvantages that for some reason we never hear about. Like it
Sure.
doesn't make sense, right? Where are all these millions of companies with competitive disadvantages that are never on these podcasts. So, and I think the thing is that the reason this happens is because people, they go out with a mindset that I need to test my pre-existing belief that my target company has a competitive advantage. And I think I do a lot of deep work and I find these proof points, and now I have proof to myself that it has this advantage, right? And then, yeah, it might be true. You might actually be true, but it might also have a different competitive disadvantage to some of its direct and indirect competitors. So shouldn't you try to spend a little bit of your analytical firepower on testing that? I had this analogy with two boxers. One, he has a longer arm, right? So he has a reach advantage. So the investors, they go out and they measure with measurement tape the length of his arm and the length of his arm of his opponent. And sure enough, he has a longer arm, so he has a reach advantage, right? Due diligence done, thesis verified. But then they don't spend the time testing his opponent, who's Muhammad Ali. So he has really high ring IQ and he's super fast. So they don't spend time focusing on Muhammad Ali's sort of speed or ring IQ. So he's at their target boxer is at a competitive disadvantage, but they haven't focused on that. They have just focused on the reach advantage. And I think that's actually quite easy because you already have these analytical recipes. You just have to invert the role. Who is who?
Right. It's interesting, the way I look at it, I talk about the infinite investment horizon. We brought up the word infinite earlier, and the kind of capital I manage for families has an open-ended time horizon. It's meant to be compounded, hopefully in perpetuity, and serve generation after generation and help them realize their dreams and give them peace of mind and so on. But then I realize, and I write about it, that we're dealing with finite assets. The businesses that we look at, they won't be here forever. And you hinted that a couple of times throughout this conversation with the studies you quoted, how the businesses, even if they have a competitive advantage today or for the next 5 years, will they have it for the longer period of time? And I see investing as basically buying streams of cash flow. And I always wonder, why does this business is even allowed to have those kinds of cash flows? And we're living in a very competitive world. And somebody notices that you're making money doing something, there are others that will try to do it. That's the nature of free market economy. If you're selling blue t-shirts and I notice, look, Simon is always sold out, guess what? I'm going to try to sell blue t-shirts too. And it's the same with any kind of business. So if you have a company that has something that we would call a competitive advantage, as in carved out, people call it a moat to make it more visual with a castle in the middle, others are looking in and trying to figure out how can we do it. And over time, eventually, we've seen it throughout history that competitors come in and they take the market share. Kodak had a leading market share for 80 years, 90 years, I don't know, but photography changed, the business changed, consumer behavior changed, and the business went away. So I like this mindset of, on one hand, infinite investment horizon, but then it's a very humbling realization that the assets we invest in are finite, and you have to continuously see if they're still as good as you thought they were, and accept the fact that they won't be forever.
Yeah, I think there's two parts related to that from my book that I think you can use. So first of all, specifically for the specific type of competitive advantage, there are some pitfalls. Like for network effects, you have sort of your typical party killers like multi-homing or sort of introduced interoperability, sort of homogeneous user preference, stuff like that. So you can test those specifically to the type of advantage. But then I think in addition to that, I have a chapter that I call Staying Power, where it's more like, so if you look at that's, I think, more useful to something where you actually have already a pretty strong advantage, but then something just comes beneath you and kills you. Like you mentioned the Kodak example. And I think that you can look at some stuff like the historical productivity. That gets a little bit more sort of theoretical, of course, right? Look at the historical productivity increases within that industry or within that technology. I mentioned semiconductors versus brewery. Or you can look at sort of the adoption curve, the S-curve. Think of elevators. Or I have this chart in my book with swimming pools. What's the installed base of swimming pools in the United States? And it follows this super elongated S-curve. It takes like many decades, probably even like more than a century to get to penetration of that S-curve. And then I compare that with MIDI ringtones, which is like this blitz, this super blitz of sort of adoption. And then so you have sort of cost effectiveness of the technology. Think about railroads. Like, you have had many new inventions of other forms of technologies, many that have all these kind of other benefits, but like railroads just still around because they're so cost effective. You have something which is like very culturally rooted. Like, for instance, beer. I'm like pretty sure that people will be drinking beer in 50 years, you know. You have these sort of external technological changes. So I think you have this, I try to provide the sort of framework, at least this is kind of my own framework for thinking about, like, the future is so unpredictable, like, regardless of what framework you have, you will not be able to foresee it, but to at least have some kind of quality way to think about it, to think about probabilities of is it likely or less likely that that market shares are gonna be more likely to shift around, and there's gonna be some kind of competing technologies.
Very much so. And the key, phrase here would be the staying power that you use in the book. And the other side of the coin is the ability to adapt to change. I think change is the only constant. We've heard it many times throughout history, that the businesses that are successful today, as hard as it is to believe, they will eventually be forgotten. I'm thinking of Xerox. Xerox ruled the office world in the 70s, before my time. I've heard stories. And I don't think anybody imagined that Xerox would be a forgotten, gone company. It's still publicly traded to the extent I know. I have no opinion about it, but it's the companies that we think today are ubiquitous in our life. We have to have it. We have to use it. We might be surprised how quickly we can move on because we have before. And I think as investors, we really have to pay attention.
I actually don't think I have I think the ability to adapt to change is something that my book doesn't really have a framework on, to be honest.
How do you think about it, though? When you think about staying power, isn't staying power about adapting to change?
Yeah, it's also about adapting, but I think the determinants that I put forth in that chapter is more like the all else equal determinants of increased probability that you're going to see rapid market share shifts, or you're going to see like rapid technological development that will rock the boat. So I think the ability to adapt, probably, maybe I capture a little bit about it with the sort of long-term thinking and long-term incentives and so on. Because I think that will probably correlate with it, but I don't have like I don't think I have any specific model for that in my book. I like, my book is to a large extent attempts to be like a unified framework for evaluating quality, but I must admit that I can't, like, there's definitely parts that it doesn't capture.
Well, I think staying power is a great way to describe it. And as long as companies can get better over time, I think that's the sign that they're adapting to change as well. I want to talk about the concept you bring up in the book, which you call fair value extraction. And I find it fascinating. I'll just share with you, quickly. When I look at businesses these days, I feel like it's a unique time in history as consumers because we get so much value, in many cases for free. And I think it became a new challenge for businesses to capture or extract value and ask to be paid for things. We get an email for free and a lot of videos we can watch for free. This podcast is for free, by the way. Hopefully provides a lot of value to listeners. But I think it's a fascinating moment for businesses. And some businesses tricked us into believing that they're growing. And I'm not going to pick on WeWork here. But they made us believe that growth, and you brought it up before, at all costs is great, but it's not. How do you think about the fair value extraction as a concept that you bring up in your book?
Yeah, so I think because I think one of the risks of focusing so much on competitive advantages, and especially these kind of like abnormal market positions where you have like high market concentration on these kind of semi-monopolistic market positions, and viewing that as a good thing as an investor, because you focus so much on these competitive advantages, then that makes you more vulnerable to then being exposed to companies that just extract too much value. There's a really great book that I have read after writing my book, which is called Winning on Purpose. It's written by the guy who invented the Net Promoter Score. Yes, I highly recommend it, actually. If I had written it before, I would have for sure made a recommendation of a reference to that book. In my book, it touches totally on value extraction. It's like more or less a book only about that. I think it's a great way to think about profit as this kind of heuristic that is just really the extracted part of value created. And you can have, like, even if you think about like something like Nick Sleep's model of sort of scale economy shared, like it isn't exactly kind of what he's saying, but still like the idea that you don't extract, you don't extract the value that you could. You do something else with it. You build something bigger with it. And I think you have these heuristic obsessed investors who like they kind of view the world in this 2-dimensional PE, return on invested capital. Like they reduce the complexity of the entire universe into this. Like I make a little bit fun of them, and my book is a little bit has a little bit of comedic elements, right? I mock these kind of people a little bit.
We all want a magic formula, we all want a simple magic formula.
I just think like you can do better. Of course, I'm not saying you should not look at return on invested capital or multiples. Not at all. Like probably people will criticize me for that. I'm not saying that. I just think you can maybe do a little bit better than that, right? And especially if you do that, then you maybe look at this. It's so profitable and it's so cheap. Yeah, but maybe the profitable part of that return on invested capital is kind of too value extractive. So it's kind of, you need to kind of adjust your heuristics for the sort of the value extractiveness of it. And you might, on the other hand, have another company, it has a lower return on capital and a higher multiple or whatever. But it's not, it's a higher quality form of stuff that's going on, It's like they are just extracting a lower share of the value that they create. So what they extract at the current moment is not necessarily like a totally good proxy of the long-term value creation that is really going on behind the income statement, and the balance sheet behind What you can look at, maybe if I can just follow up, like you can look at customer return on invested capital, you can look Net Promoter Scores, you can interview former customers, you can look at sort of have they jacked up prices a lot. You can also look at sort of value extraction on the supplier side and employee side by interviewing like former employees and former suppliers, stuff like that. If you can do some stuff to try to evaluate what I call value extraction risk.
I think it's a fascinating topic because you can't really see it in the income statement, the balance sheet or cash flow statement. It's something that you learn in a nuanced way through reading, interacting with the business, interacting with people that interact with the business, and you can almost leave it unnoticed, but it feeds back to your durability point, because if you have a company that treats the suppliers well and treats employees well and treats the customers well, you would think that it has better odds of success, especially for a tough time when the customers will stick with this company. They will not feel like, oh, this is a chance to break away from that business, or the suppliers would still supply in moments of distress. At the end of the day, going back to what you mentioned at the beginning, it's people running businesses, interacting with people, needing services and goods. If you treat everybody well, they'll show up when you need them. You create a certain equity with them that goes beyond what's visible in the formulas that people are looking for. And it takes a little bit more work to figure it out, and a little bit of a gentle touch to see where this is actually happening. And I like the term fair value extraction. I feel like businesses could learn from it because it helps them stick around. I was thinking when I was reading your book about this ideal quality durable business of the future. And to date me for a second, when I was reading your book, I was thinking, you're right about scalability, so that I had one image of something that's easily scalable, globally, and we see more and more businesses that show up, and within a few years they're in 150 countries. Then I was thinking about being capital light. I've been in the business 20 years. I remember investors that I worked with early in my career that were all about asset-heavy businesses because it's on the balance sheet, because it's a low price to book. You didn't bring up price to book, but some people used to use price to book back in the day.
Yeah.
But we're living in a more capital light, asset light business world. So I think it's fascinating. And then you bring up something in your book that's called geographically replicable business model, which I find fascinating, where something works in one country, not just one state or one province or one zip code, but it could actually work across the globe, which means that you tapped into some universal need that we have globally. So how do you think about this dream company? If you entertain me for a second, how does this company look like, the company of the future, if you could build it from imaginary blocks, a perfect, ideal, future, durable, quality business?
I don't think I could really. I don't think I could. I think really the point I make also at the end, I make this point with this top trumps, this card game with cards. I think in the real world, one of the criticism I got from some of my reviewers, oh, this book is like this crazy checklist where there's 3 companies left on the planet. And I'm like, no, this is not my point. The point is that you can use this to get a better understanding of quality, even of crazy deep value cases and stuff. It's just to have a better informed view about the various aspects of quality. So I don't think I will create this sort of imaginary perfect company. On this stuff with geographical replicability and stuff, I had this chapter that I made about sort of proven unit economics, and I think this is where it's from, also lifetime unit economics. So of course, it's nice if you have a business model that is proven. This is a little bit more for the, this is not if you understand, elevators, something. This is for the people who are maybe a little bit more growth equity or emerging quality kind of investors, where you can have some discussion around, is this business model actually proven? Because maybe there's so if you have had decades of good returns on capital, positive, you have been profitable through cycles, through downturns and so on, well, then you can say the business model is proven. It has held up in crises. It has survived this and that. But then I think there's some gray area where it has, some people say this business is not proven because look, it's just hovering around break even and therefore it's not proven. There I say, I think it's useful in those situations to try to think about, maybe what are some of the reinvestments that are going on behind, again, the kind of heuristic numbers, that is useful to think about. So for example, if you have a company it is profitable in a percentage of where it's active geographically, and then it's active in other geographical areas, maybe the other areas is sort of a little bit earlier on the curve. They have more OPEX, they need more critical mass to break even, so that kind of dilutes your consolidated earnings. So it makes you, if you just look at the consolidated numbers, you miss what's going on. The same thing with lifetime unit economics. If you really, that I have these formulas, if you assess sort of, instead of focusing on 1 year, which is when you think about it, really an arbitrary time period. Everything is over a 1 year time period because that's the way it is. Why is it like that? Because that's how our society is a lot of stuff we measure it over a 1 year period. But why is it?
Sure.
Doesn't it make more sense to basically view it over the course of the lifetime of one individual customer, the average customer, and then look at the economic profile of that? And sometimes you can see that the lifetime unit economics are really, really. So two investors who focus on two different things can arrive at two totally different conclusions, whether or not this business is profitable or not. So the one focusing, for instance, on unit, on sort of, there's a huge focus if you're focusing on per unit numbers. I have this chart, also you see a lot of companies that are sort of scale ups, what you call them, the time where they lose the most dollar amount of money is actually just before they break even typically. But but if you view that on a per unit level, so I have these charts where I show it one absolute and one per unit. It looks quite different, actually. It looks like the one with per unit actually looks like it has improving unit economics. So it's you can actually see that it's rapidly approaching break even. But for the other one, just focusing on the consolidated numbers, it looks like the business is just like gonna lose more and more money, right? So, but I think there's also some dangers in that. You can fool yourself with those kind of exercise. You need to be careful, of course, because you can get yourself into a growth trap or something where it is really not proven. But I think there's definitely some exceptions to just looking at return on invested capital.
I think it's a really profound point, because when I'm thinking about the future businesses, we will have businesses that require upfront investment, that when you look at the consolidated P&L, you might be looking at losses for quite a while. But then when you look at the units, you're adding millions or tens of millions or maybe a billion of users, right? So when you think about the unit economics, they give you a different picture, just another ingredient to your formula, your study. And maybe will show you a different idea of how the business is actually doing. And I think it's an important point to make, because I think there will be more businesses that require that kind of analysis, where for a while, when you're reaching the scale or the network effect, it looks like you haven't proven your business yet. And then we tip over to the other side, and suddenly we realize how it's a moneymaker because they reached the right size. Speaking about the future, you have a whole chapter towards the end where you talk about risks. And actually, as an analyst, money manager, I bring up risks in every discussion. I feel like they're important to consider. And we can't predict the future. And successful quality businesses, to me, are a target for both competition and regulators. They're just the attractive object moving around. So, and they're also global. So you talk about geopolitical risks that arise as well. When you're present in 100, 150 countries, there are other risks. How do you think about risks that those businesses face, and how do we navigate that territory?
Yeah, I think I divided into different kinds of risks that are kind of generic risks that you can that you should always consider. But then I think there are also a different kind of risk that I call other risks or unpredictable risks. So maybe let's start with the first ones. You have something like, like dependency risk, which is very common, even among some of the world's most valuable companies. If you actually consider it, like many of them, they have some huge dependency risks. So again, back to the point of like there's very few companies that are kind of perfect. Then you also have, of course, leverage risk is something you should always consider. You have geopolitical risks, you have diversity of income streams. I have some different models to analyze each of those things. And I think there's a lot of, I talk a lot about analytical risk. So kind of, that's really like a recurring theme, I think, throughout the whole book. And especially also in the appendix, like just the risk that you make an error in your assessment of whatever topic it is. But then you also have unknown risks. And I think it's actually kind of interesting. I think if anybody listening to this has like a decade of professional investment experience or something, try to go back and think about sort of how historical cases have unfolded relative to if you have documented your original sort of assumptions. At least in my case, I think that in a lot of the cases, just something happened that I just hadn't thought about at all. Like a lot of stuff, a lot of the future is just totally unpredictable. Mm-hmm. Like even if you have done all this work and you have great colleagues, very skilled organization, a lot of resources and so on, just a lot of stuff is just like really unpredictable. Just a lot of stuff happened that, where did that come from? Like, why on earth did that suddenly happen? And that had this effect that led to that effect. And it was one of my reviewers, Brian, who said, you need a section on unknown risks. And it was such a good suggestion. It was such a good suggestion. And I'm so happy I had that. I have this quote, this famous Donald Rumsfeld quote about, known unknowns and unknown unknowns and stuff. And it's like, it's right. You need to acknowledge that regardless of how much work you do and how clever you are, you just need to be humble, because you cannot predict. There's just some parts of it you cannot predict it. But it's great, to think about that in relation to, now my book is not about portfolio construction or something. So I am quite concentrated investor myself. And I think just being a little bit humble about the sheer randomness of the future makes you at least think a little bit about kind of within this very concentrated mindset, how super concentrated do I want to be, or at least how do I think about sort of internal diversification and stuff like that, because you just need to be a little bit humbled by the randomness of the real world.
I like this phrase that I use a lot. I say that I want to be the least wrong. And a lot of people go into investing to be right. They love being right. I enjoy being right. But first of all, I want to be the least wrong. And there are two things that I would suggest for anybody listening. When I look at a business and I analyze a business, I think of the thickness of the folder. I'm thinking of the physical folders that we used to have. These days, it's on your computer. You can't even tell. But if the business requires a very, very thick folder to analyze, there's so many more things that you might be missing. That's how I look at it. So the thinner the folder, hopefully there are fewer things that can surprise you, but you will be surprised for sure. And the last thing I would add is you don't have to own one single business, right? You talked briefly about portfolio management or construction. You might choose to own a bunch of them, and you find your comfort zone, whether it's 5 of them or 50 of them. I don't know. It's up to you. But you have to leave enough room. I do leave enough room that one of them or a handful of them will surprise me on the competitive side, on the regular side, on the consumer behavior changing aspect of it. We went through the pandemic and we've seen people change how they operate very, very quickly. And I'm sure there will be other experiences in the future that will change how we live, act, work, and so on. See how the businesses you hold could be affected by it, and your imagination might be really, really stretched. Simon, I could keep you here all day, but I want to ask you about your definition of success. You're launching a new business. You have a book that will be a bestseller. How do you think about success?
I don't know. I don't know. I think I was on a mental journey writing this book because at first, so I'm sure there will be some sort of misconception that because I did stand up and so on, that I set out to write like a comedy investing book, which is like totally not what happened. I had written this super dry investment book. Like it was so dry. The first people who read it, they were like, oh, like it didn't get very good feedback in the beginning, right? Like that was I had finished the first draft in October 2023, right? So that's now it's more than a year ago now. And one of the first guy who reviewed it was a guy who is called Thomas Plenborg. He's a Danish professor at the Copenhagen-based school, and he said, "Where's your personality, man? You used to be a comedian." and that kind of pushed me into adding these small bits of. I'm getting back to your question. I'm not drifting. Yeah. Adding these small bits of humor, and at first it felt really, really like kind of groundbreaking, or it felt really weird. Like I will embarrass myself. Like it's the same dynamic when you go on stage and stand up. The reason people fear doing stand up is because they risk embarrassing themselves in public. And I had this feeling, okay, I'm not just gonna, when you do stand-up, you embarrass yourself in a room with some people that you will never see again. You're right in front of them, but you will never see them. With this book, I will embarrass myself at like a global scale. I will make myself a fool in like a total public at a global scale. And it felt really, really weird. But then at some point I got over this hill of like, but this is what feels right to me. I always had this dream. I had this note on my computer 5 years ago. I found it. It was so weird to find it again and see it. Like all of the stuff had kind of happened. Like I had this dream. I really wanted to write an investment book. I also really wanted to write like a kind of comedic, philosophical novel. And I would like to have a day-to-day job where I could just kind of do what I want, read, and and now all of this stuff kind of just happened. I just what I hadn't anticipated is that I would combine the two different dreams into one. But I think back to what's my definition of success. I think it's kind of like Buffett's inner scorecard. I think this is really like I made this book that I think is cool because it combines the uniqueness of me. And probably there will be a lot of people who thinks it's silly and investing is not, it's supposed to be serious and why do you mix the stuff in and so on. But I think for me, it feels right. And it was so encouraging to see people actually liked it. So if I like it, other people also like it. Of course, there will be like the majority of people will probably hate it, but there will be some people who like it, and that's so cool. And I think, yeah, it's a little bit frightening to do that, but I think you just gotta do it. You just gotta measure your success based on kind of how you want to be, you know?
I think it's a beautiful way to put it. And I have so many thoughts about what you said. Well, first of all, writing down your goals, your dreams. And that's a great way to have them come about over time. You were doing stand-up comedy. You find a book, an attempt to get embarrassed in public. I started publishing what I write about 10 years ago, maybe a bit more now. And I realized that your writing takes a life of its own that you don't have control over. The same way this podcast takes a life of its own. And I feel like I said something, but then how people hear it, you don't have control over it. And even me reading your book and the questions that I have, they inspired something that triggered something from my experience. And you said, that exceeds what's in the book. But that's what the book does. It brings up things that are from a personal experience. And I'm sure there'll be others writing to you about your book that some of the chapters will bring up something from their experience investing or their aspiration to start investing, and you'll be surprised in many different ways. And sometimes you'll say, where is this in the book? Like I ask people reading some of my writing and my books, where is that in the book? And they say, no, it's not in the book, but it inspired me to think about it. So I think the beauty of it is that you let it be what it wants to be at this point, and then have fun with it, go with the flow, because some fascinating, cool things will happen with people reaching out to you. And it's an incredible read. And there's so much in the book. I feel like each chapter could be a book by itself that I want to pull out at times and dive into a specific aspect of what you consider quality and durability of a business, and whether it's the incentives we talked about, the people who are running the business, the capital allocation, or the staying power, and all the other terms we brought up here. But there's so much more in the book, and I highly recommend this audience to dive in, find the book, read it at your own pace, and incorporate some of the ideas into your process or thinking, because there's a lot of helpful thought that you left on those pages. Simon, thank you so much for today. This was incredible.
Thank you. I just wish I had known about your Polish background. It's actually embarrassing. I didn't think about it given your name. So my wife is Polish, so I could have brought some good slivovice from back home. We could have had a slivovice on the show. I wish I had done that. Yeah, we have to do another episode.
What's her name?
Agata.
Well, say hello to Agata and run home. I know it's late over there, but it was such a pleasure to spend this time with you. My midday, your evening, afternoon, and I'm looking forward to many more conversations, and I wish you best of luck with the book. It's a terrific read, and I really enjoyed it.
Thank you so much, Bogomil.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogomil Baranowski.